Hey, welcome back. I hope you're keeping well and staying safe, of course. So, today we're looking at how to intellectually stimulate ourselves because we've come a very long way, haven't we, in forensic accounting? We've had an overview of data analysis techniques. We've looked at the overall framework within which forensic accounting rules fit in practice. So the different roles that you'll be looking for to be getting involved in. And last week, we prepared ourselves nicely for various financial reporting and auditing roles. During the lecture, we spoke about whose responsibility it is to prepare financial statements. We looked at various situations that could lead to misrepresentations and how misrepresentations could lead to fraud. Okay, so what we're going to do in this seminar is we're going to pick a very common task that we get ourselves involved in as accountants. But it is so beautiful, it is so fantastic because looking at how you conduct an impairment review in financial reporting brings with it a lot of knowledge and competencies that on this course you've learned in management accounting, in financial management, and for some of you in the audit modules. So I love it, right? This is intellectual stimulation at its best. Right, so let's get on with it. Well, apart from the short-term gains of preparing sufficiently for your assessment for this module, I believe bringing all these competencies together is going to be very useful for you next year in the final year, right? Both in your theoretical modules and in your research-based modules. So, for example, if you look forward to your financial reporting, management accounting, financial management, and audit modules, I can bet you that you will recall what we're doing today, right? It brings everything together nicely and stimulates you in terms of thinking. Okay, so let's get on with it. The task is, as usual, set within the context of spotting the error, right? Okay, spotting what has gone wrong. So let me give you the backdrop here. We've received information or representations from either an accountant or an auditor that said that when they conducted an impairment review for a non-current asset, they decided that there is no impairment because the recoverable amount of the relevant asset was higher than its carrying amount. Well, all things being equal, I hope you remember, if that is in fact the case, then indeed the asset is not impaired. But we are analytical. We probe, we question, we analyze. We don't take things at face value as forensic accountants. So we have to check the records. We have to verify to see if indeed the underlying accounting records and the assumptions and the techniques that they've used in conducting that impairment review is consistent with the conclusion. Okay, so what do? We have to check the data on the carrying amount, and I think that's what we see here. We can see that the cost of the asset is given. We know the accumulated depreciation is given, and if we just double click on that, we can see that the carrying amount is indeed the difference between the cost and the accumulated depreciation. No problem. Well, just to give you a clue here, right, the colored cells in Excel here are where the computations have taken place, and those are very important. Those are the cells that we are really focusing on for now. So yeah, let's just create a tab here. When I would say verify, that means we are happy, and if we are not happy, then we would state it as well. So we are happy about the carrying amount. Let's give it green. Oh, is that green? Yes, that's green. But of course, we may want to dig deeper. We may want to go and check the records for accumulated depreciation. We've done that in our previous tasks, haven't we? We verified the non-current asset accounting figures for different tasks. So for now, it's okay. We're not really worried about that. The fair value less. So we come back and we look at we're not really worried about that because we've already completed those tasks in our previous spot the error activities. So we will take it that the accumulated depreciation is correct. So we've verified the carrying amount. We've been given the fair value less cost to sell, which is relevant when we're calculating the recoverable amount, isn't it? Because the recoverable amount is a higher of the value in use and the fair value less cost to sell. Again, we may want to verify the estimation techniques. How did they go about determining the fair value of the asset, and what types of costs have they recognized in the cost to sell? But again, for now, let's assume that this is correct, right? Let's assume that we verify that and we're happy. Let's give it a green. So what we need next is we need to know the value in use. And we've been giving data here for this asset. The value in use being the cash flows that are attributable to this asset, or if the asset doesn't work or generate cash flows individually, then what would we be looking at? We'll be looking at the cash generating unit, isn't it? The group of assets. So for now, we've been given the future cash flows, and there is some indication here that these cash flows that are attributable to this asset have not been discounted. Right, so we have for the next 4 years, we've got first year, second year, third year. And if we just double click on that, what the accountant has done is the accountant has just added the future cash flows together and come up with a figure of 748,000. So presumably, as you can see, what's happened here is they've compared these two, right? They've compared the fair value less cost to sell and the value in use. They've picked the higher of the two, which is 748,000, as the recoverable amount. They've compared that with the carrying amount, and that is why they came to the conclusion that the asset was not impaired. Because if indeed the recoverable amount is 748 and the carrying amount is 711,100, then the asset is not impaired. Right? But we are not happy that these cash flows have not been discounted, because if they are future cash flows, then they should be discounted to their present value. That's a clue, right? So we are not happy with that, right? That is not verified. So what do? Let's give it a not so good color. What color? Let's go for blue. Right, let's make it blue. Means we are not happy. We need to ask more questions. We need to go dig a bit deeper. Right, so we've called for data that would enable us discount these cash flows to their present value and find a revised recoverable amount. And to be able to discount, what do we need? We need a cost of capital. Where do we get a cost of capital from? The cost of capital is the weighted average cost of capital. And there we go. We have to go zap into our knowledge from our financial management module and remember how to calculate the weighted average cost of capital. The data here relates to the source of capital. So we have some equity and we have some bonds. Oh, look, they've got their own estimate here. Right, so let's go down and verify. So they've calculated the... Oh, they haven't. Oh, have they? Let's keep going down. Oh, there. Right, so I can see here that they've got a WACC, which is good, right? But then are the figures that have gone into the WACC correct? Probably not. Okay, so we will start working backwards from here, right? We can see here, if you check carefully, right, so there we've got the first element of the WACC, which is multiplying the proportion of, which proportion is that? Let's just do it again. I've just separated it. So the proportion of equity, so the total of equity divided by the total of capital multiplied by the estimated cost of equity, which they have here. So that looks right, right? They are using the right technique is what we're saying. And then subsequently, they've added to that the value of debt divided by the total of capital multiplied by the cost of debt. Right, so that formula there is correct. Right, let's give it green. Let's give it green. And let's say we verified the formula. What we cannot verify, what we cannot confirm yet is we cannot confirm if the inputs to the WACC are correct. Okay. So we need to verify the calculations for the value of equity, the value of debt, the cost of equity, and the cost of debt. And if they are correct, then we can pick this number and then use it to discount the future cash flows for that asset to find its recoverable amount. Okay, so let's unpick it. Let's do it one after the other. Let's start off with what they have here. Right, so they have dividend growth rate. Dividend growth rate? Well, they haven't given us the calculation for that. Right, so we cannot verify that. Not verified. So we should calculate our own, right? So we need to go back to the dividend data that we've been given here. And I think we did this last week, didn't we? We did this last week in our spot the error calculation. If we have a sequence of dividends, we can calculate the geometric growth rate, the constant growth. So let's do that. So be careful with the years. The most recent is that one. So we divide the most recent by the first in the sequence, and we raise that to the power of 1 divided by the number of changes. The number of changes would be 1, 2, 3, 4, isn't it? If you have 5 numbers, they would have changed 4 times. So it's always the number of numbers, the number of numbers minus 1, n minus 1, we said. So we divide that by 4, and we subtract 1 from that because we want a percentage. So let's go bingo. Oh, good, that's it. So the growth rate in the dividends should not be 8%. It should be 6.48-ish, right? So this is verified. Then we look at the cost of equity. Again, they haven't given us the estimate, so we are not verifying that. We can't confirm that. We need to calculate it ourselves. And how do we calculate that? Well, we can see from the data that we've been given here that we can calculate that using CAPM, Capital Asset Pricing Model, because we have the risk-free rate of return, the beta, the market return. So let's just do it. So we pick the risk-free rate of return plus beta multiplied by the market return minus the risk-free rate of return. I'm just going through this quickly because we did this in our spot the error activity last week. Good. So again, that is different from the figure that they've got there. Okay. So now that we know the growth rate and we know the cost of equity and we know the most recent dividend, we can then verify their value per share here. Right, so you can see from their value per share what they are doing. They are picking the most recent dividend plus the G, the growth rate that they had there, dividing that by K, cost of equity minus G. Right, good. So they were doing the right thing. They were using the dividend valuation model approach to value the equity, but they were using the wrong inputs. So again, we cannot verify that. We cannot verify their value. We need to calculate our own, not verified. So we need to use most recent dividend multiplied by 1 plus the growth rate that we've just estimated, and we discount that by the cost of equity we've just calculated minus the growth rate. Right, so the dividends are in pence, and therefore we will have to convert this into pounds. It should be about 10.11 pounds, let's say. Right, which is slightly different from what they had there. Okay, so that one there needs to change. So let's just create our own little valuation, the WACC table here. So let's say the value and the costs, right, should be the costs for cost of equity should be that one, and the value should be that times the number of shares. And we know the number of shares is given here. Good. Now we move on. So we've done that. Now we need to move on and check the value of debt. The value of debt, I think we've been given the price per £100 worth of bonds here. So we can just verify that. So that's out of every 100 for the total nominal value of that. Oh, they were right. They were right with that one. So we can just do the sum and get the total for capital. What we need to do now is we need to verify the cost of debt. So they've got cost of debt here, and if we just double click, we can see that what they seem to be doing is they are using the linear interpolation formula that we came across in both our financial management and our management accounting module when we were calculating the internal rate of return. So we can see that's what they've done. They're calculating the IRR using the linear interpolation formula, because I can see they've discounted using 10% and 5%. They've got two NPVs, and you can see they're using the smaller plus the NPV of the smaller divided by the NPV of the smaller minus the NPV of the bigger. Yeah, so the formula there looks right. We need to verify the figures that have gone in there. They've picked the price and they have calculated the interest. So how have they calculated the interest? They've done, is a 9% bond, is it? 9% bond? Yes. So 9% of 100 times 1 minus the tax rate. So what they are calculating there is they are calculating the interest, or if you like, the coupon that the bondholder will be paid. And they've got the redemption amount being 100, which is fine. And they are treating the interest as an annuity. Yeah, so I think they've just got this from the annuity table, or they've calculated that using the annuity formula. That all looks right. Yeah, that looks right. So you can check, but I think from the quick glance through these, clicking through, we've seen that they've calculated the cost of debt appropriately. So we can verify that. We can verify the cost of debt calculation. So verified, and therefore we adopt it. Okay. So on that basis, then we can recalculate what the cost of, so the weighted average cost of capital should be. And that should be the weight of equity divided by the total of capital times the cost of equity plus the weight of debt divided by total capital times the cost of debt. Cost of debt after tax, isn't it? That's why they were taking the 20% off there. So that's fine, which means this should have been the weighted average cost of capital. And that is the figure that we need to discount these cash flows. So let's just make room here and calculate. Oh, sorry. Let's make room there and calculate the present value of cash flows. So we go PV of cash flows. Right, so what do? If we are discounting, we just multiply each of these cash flows by 1 plus the weighted average cost of capital that we just calculated. Right, we raise that to the power minus 1, which is the time that the cash flow will occur. I think I'll be better off just fixing using absolute referencing for the weighted average cost of capital so that I can drag, isn't it? I'm lazy. Right. So with that, we can calculate the present values of each of these cash flows. You can see the formula has worked. I hope you're not confused, right? I just did the cash flow times 1 plus WACC raised to the power minus n. Right? If you wanted to do cash flow divided by 1 plus r raised to the power n, you could do that as well. So let's just sum it up now. So we sum the present values up, and we realize that this should be the recoverable amount. And if this is the recoverable amount, then the asset will be impaired, isn't it? Because let's just rephrase it. So we need to calculate the recoverable amount now as the higher of these two figures, the value in use, which is 571,491, and the fair value less cost to sell, which is 485. Okay, so we will pick that. Let's put this in green. That will be our recoverable amount. And if we compare that with the carrying value or the carrying amount of 711,100, we can see that the carrying amount exceeds the recoverable amount. So our ultimate decision then, just go down on this working sheet, we'll go down and say we disagree. This is hanging up a bit, sorry. So our ultimate decision or opinion is that the asset is impaired since the recoverable amount, which is the higher of value in use and fair value less cost to sell, is lower than the carrying amount. Phew. So yeah, that I think is the end of it. And I'm just going to save this, and I'll be putting this up on Moodle. I'll put both the video and the Excel sheet on Moodle for you to review. But I hope you can see how the various technical knowledge that you have in financial accounting, in terms of impairment review, links in with the knowledge that you got from management accounting, about the calculation of IRR, and also financial management when you looked at how to value equity and debt and calculate weighted average cost of capital. It's all one thing, right? And I hope you've enjoyed it. All the best, and I'll see you soon.